So, I heard you want to join us. You want to invest. Good. Now the next question is, where do you put that money to work? First, ask yourself, should I invest in myself? Investing in your education or skills can boost your income and help you contribute more to your investments. As we discussed earlier, your contributions early on are more important than returns. If you can increase them by learning or growing, do it. Education stays with you for life, changing how you approach the world and opening up new opportunities. The second key point I want to make, something we discussed earlier, is that in the beginning, your portfolio's growth comes more from your contributions than from investment returns. For example, if you set aside $500 per month, that's $6,000 per year. By the second year, your contributions alone have doubled the value of your portfolio. By year 3, you've increased it by another 50%. It takes about 16 years before your portfolio's growth slows down to around 7% per year, which is similar to the average market return. Now, imagine taking that year 16 investment and using it to invest in yourself, learning a skill that allows you to save $1,000 per month instead of $500. Suddenly, your contributions dwarf your returns again. And the best part? Both of these factors, how much you invest and how much you improve yourself, are completely within your control. Another important factor to consider before you invest is the structure you invest under. Tax can be one of the biggest drags on your profits, especially as you earn more. Many governments offer tax incentives to encourage saving for retirement. For example, in Australia, there's superannuation, and in the US, you have 401ks and IRAs. If you're investing for the long term, you must consider the tax implications. Choosing the right structure can make a significant difference in how much wealth you ultimately build. More videos will be made on this topic in the future. Make sure to subscribe so you do not miss them. Now let's talk about stocks or shares. For beginners, shares are often the go-to because they're easy to access and don't require a large amount of capital to start. But here's the truth. Stock picking is tough. Even the pros struggle to do it consistently. If you're not planning to become a professional investor, there's a better, simpler way to grow your money. Let's break it down. Stock represents a piece of ownership in a company. The way the investor gets their money back, and more, is mostly through dividends. These are the payments distributed to shareholders, you, once the company has covered its operating expenses or reinvested in growth opportunities. Of course, if the company is well managed, it will grow over time, and so will the value of your ownership. The next question is, what to buy, when, or at what price? First, you need to acknowledge that you don't know much about picking a good company or stock. What's the chance you get it right with your current level of knowledge? And even if you somewhat get it right, how many times can you repeat this before you make a mistake and lose it all? So, what should you do instead? It's simple. Broad-based ETFs or index funds. Imagine you buy a single share of the 500 biggest US companies. It would cost you around $45,000 plus brokerage fees. With an ETF, you can achieve the same thing with far less money. A fund manager has built a portfolio with millions of dollars and is selling fractions of it as units for you to hold. This allows you to achieve the same diversification as the S&P 500, but at a lower entry point and a lower cost. In short, ETFs are low-fee investments that let you own a little piece of many companies, spreading your risk and increasing your chances of steady returns. Why do they work so well? They don't require constant attention, and they're automated by fund managers. They aim to give you the market's return, no more, no less. And the low fees? That means more of your money stays invested. For example, an ETF that tracks the S&P 500 gives you exposure to 500 top companies in the US. It's simple, low cost, and efficient. Plus, as you build up your capital, you're saving time and money by not having to manage a ton of individual stocks. Or, if you're in Australia, you might look at the ASX 200, or in the UK, the FTSE 100. They offer the same broad exposure, but with local stocks. People from all over the world tend to gravitate toward the S&P 500 because it contains some of the most successful global companies. If you want to further diversify, you can go global. There are funds that track markets outside of the US too. When selecting an ETF, the key things to look for are: 1. It should be from a reputable fund manager. 2. The fee should be low. 3. The price of the unit should broadly align with the underlying value of the businesses you will be holding. Look for a price close to NAV, net asset value. 4. Consider the currency the ETF is denominated in. Some ETFs offer S&P 500 index funds in the local currency, which can protect you against currency fluctuations between the US dollar and your local currency. But it comes at a cost. 5. Finally, check if they offer to reinvest dividends. Now, you can also use tools like ChatGPT or other language models to quickly gather this information and conduct a comparison. Let's take a moment to talk about time in the market. As you begin, you'll notice that the earlier you start, the more time your investments have to grow. Trying to time the market, waiting for the perfect moment, can be dangerous. History has shown us that even missing a few key days of growth can have a major impact on your overall returns. This is where dollar-cost averaging comes in. By investing a fixed amount on a regular basis, you're spreading your investments over time, which reduces the risk of putting all your money in at the wrong moment. Now, I know the allure of high-growth investments can be tempting, especially when you see people claiming massive returns. But here's the truth. High-growth investments often come with high volatility. This means, while there's potential for massive returns, there's also the risk of losing it all. In the early stages of your investment journey, don't chase the next hot tip or try to get rich quick. Instead, focus on building a solid foundation with low-cost ETFs or index funds that will give you broad market exposure. Once you've gained experience, you can gradually look at more complex opportunities. But for now, stick with what's tried and tested. The key is consistency and discipline. Time in the market, not timing the market. Over the long term, the market tends to go up, and investing consistently lets you take advantage of that upward trend. Don't focus on short-term fluctuations. Time in the market beats timing the market. Now that you have a solid strategy to start your investment journey, it's time to take action. Don't wait for the perfect moment. Start today and build your future step by step. I'd love to hear from you. Drop any questions in the comments and I'll make sure to answer them. Be industrious, brothers. Are you ready to join us on this journey? Are you ready to win? If you're enjoying this content, show some love, hit the like button, and give it a thumbs up.